Some people think the economy is like a roller coaster. It goes up and down, it expands and contracts.
All investment entails risk. Deciding how to invest requires us to understand both the extent of the risk as well as our attitude to risk. How willing are we to take risks?
Hang on tight.
No risk, we invest in a savings account. Some risk, we might consider money market funds. More risk can be found in a mutual fund. The stock market poses even higher risks. The greatest risk in investing is in new businesses or venture capital.
It really is true that the more you risk, the more the potential return. If you're willing to settle for less return, then take less risk. Everybody's got a risk tolerance. Everybody feels more comfortable or less comfortable with different investments. A lot of what we have to go by is history, and we can look back over many, many years and see that in general, stocks are going to outperform other kinds of investments. That doesn't mean every single stock, that just means in general, so there's risk in that for sure. But one of the things you've got to always be paying attention to is you've got to grow your money at a rate higher than the rate of inflation, or you're falling behind. And so stocks give you the best potential, stocks and real estate I would say, give you the best potential to do that. Safer investments, especially nowadays, the safe investments are almost guaranteeing that you're falling behind the rate of inflation, the cost of living.
The third risk mitigating strategy has to do with protecting your financial investments. Whenever you invest your money, you run the risk that it will lose value. In this situation, you face two types of risk: firm-specific risk and market-specific risk. Firm-specific risk is the risk inherent in investing in only one company. So for example, if a software company writes a product of low quality that no one wants to buy, this company might go out of business. If you had purchased stock only in that company, you would have lost money. If instead you had invested your money in a variety of stocks and bonds or mutual funds, then you could have avoided this firm-specific risk.
Market risk is the risk associated with the entire economy. For example, in a recession, even good firms face hard times and may have financial troubles. To some degree, you can avoid some of the market risk associated with a particular nation's economy. You could buy assets in nations outside the U.S. to avoid U.S. market risk. However, as nations become more and more engaged in the global economy, there is a global market risk that is unavoidable.
Risk tolerance in investments often changes with age. When you're early in your working years, you can afford to be riskier in your investments because you have time to ride out the ups and downs of the stock market. As you transition towards your retirement years, it's wise to put your investments into safer assets.
If they had more knowledge of what actually, how the markets worked, whether it was in 08 or 09 or in 2000 or 1930s, more knowledge would probably give them more risk tolerance. Knowing how supply and demand work, knowing how companies bounce back, knowing how business cycles work and profit cycles work, I think they could see, okay, it's going to be down for a while, but it's going to come back. It's not going to go down and flatline. So with that knowledge, I think it gives you more risk tolerance.
Let's not forget that there are other forms of investment. For instance, you might choose to invest in education, learn new skills, or acquire new credentials. You might choose to start your own business investing both your savings and your labor. Some might even choose to invest in the lives of children in far-off places by funding clean water projects or infectious diseases like malaria.